Susan stopped working at 62. 3 decades as a public school educator in Pennsylvania. She had a traditional IRA sitting at $240,000 and a pension that handled her monthly expenses. Her financial planner advised her to leave the IRA untouched. Let it compound. You will not touch it for a long time. So, she listened. She forgot all about it. Then she hit 73 and the IRS mailed her a notice. She was now obligated to pull out more than $9,000 from that account regardless of whether she wanted the funds or not. That distribution, stacked on her pension and her Social Security, bumped her into a steeper tax bracket. Her Medicare costs increased. On top of that, her Social Security became subject to taxation. And her planner, the person who advised her to let it sit, had never once brought up a 4-year opportunity that began in 2025 and vanishes permanently in 2028. An opportunity that could have protected Susan from tens of thousands in taxes. Right now, she is watching it disappear. This video is strictly for educational purposes and does not constitute tax or financial guidance. Speak with a licensed tax professional before making any choices regarding your individual circumstances. Every single week, this channel breaks down the tax codes, the financial pitfalls, and the approaches that shield retirees from the issues nobody else is talking about. If that sounds like content you want, press the subscribe button right now and activate notifications so you catch every single video. Today, I am going to guide you through precisely what this opportunity is, why it only exists right now and never before, why it permanently vanishes at the conclusion of 2028, and the 3 errors retirees are committing right now that destroy it before they ever get an opportunity to take advantage. Let me begin with the basics. Most retirees have encountered the term Roth conversion. Hardly any grasp why executing one right now in 2026 is unlike any other point in history. A Roth conversion is the act of transferring money from a traditional IRA into a Roth IRA. When you execute that, you owe income tax on the sum you transfer in that year. In return, that money compounds entirely tax-free for the remainder of your life. No taxes on the appreciation, no taxes on distributions, and a Roth IRA carries no required minimum distributions. The IRS can never compel you to pull money out of it. When you keep money in a traditional IRA, the reverse is true. Every dollar sitting there will eventually face taxation. And beginning at age 73, the IRS mandates that you start pulling money out whether you want it or not. Those are known as required minimum distributions. A traditional IRA holding $240,000 at age 73 produces approximately $9,300 in mandatory withdrawals in the initial year alone. That stacks on top of your Social Security, your pension, your investment earnings, and the IRS taxes everything together. That is exactly what happened to Susan. And it is what is approaching every retiree who holds a traditional IRA and has not taken action before 2028. Here is what separates this opportunity from anything that existed previously. 2 developments occurred simultaneously that have never aligned at the same moment in history. The first is a recent law, the One Big Beautiful Bill Act, enacted on July 4, 2025, established a brand new deduction for Americans aged 65 and above. It is known as the Senior Bonus Deduction. If you are 65 or above, you can subtract an additional $6,000 from your taxable income. If you are married and both partners are 65 or above, that increases to $12,000. This sits on top of your current standard deduction. On top of the current senior deduction, you can use it whether you itemize or choose the standard deduction. It makes no difference. But here's the essential detail. This deduction is accessible only for tax years 2025 through 2028. After that, it is finished. Congress has not renewed it. It expires. The second development is that the identical law permanently secured the existing tax brackets. Before the One Big Beautiful Bill was signed, those brackets were set to snap back to steeper rates at the conclusion of 2025. They did not snap back. The rates you observe today are now permanent statute. This is significant because when you move IRA funds to a Roth, you owe tax on the converted sum at your ordinary income rate in that year. Lower brackets mean you spend less to shift that money to tax-free standing permanently. Combine those two developments and you have something that has never been available before. A temporary deduction that shrinks your taxable income layered on top of historically reasonable permanent tax brackets, forming an opportunity to shift IRA funds into a Roth account at the cheapest possible tax expense. And that opportunity ends at the conclusion of 2028. Let me demonstrate what this looks like with actual numbers. Consider a married couple. Both are 66. Social Security payments, a modest pension, no earned income. Their total income before any IRA transfers is around $80,000. In 2026, their standard deduction is $32,200. Their current senior deduction for both partners combined is $3,300. And now they receive the new senior bonus deduction of $12,000 stacked on that. That is $47,500 in total deductions protecting their income before they owe $1 in federal tax. If this couple transfers $20,000 from their traditional IRA into a Roth right now, the senior bonus deduction absorbs a large portion of that conversion. The tax expense of permanently moving $20,000 beyond the IRS's grasp is substantially lower than it would have been in 2024 or than it will be in 2029. Across the entire 4-year opportunity, a qualifying couple can shift up to $48,000 into Roth standing using this deduction alone. $48,000 that in any other 4-year stretch would have cost them thousands extra in taxes. Now, let me introduce you to 3 individuals who are approaching this opportunity 3 separate ways. 2 of them are committing expensive errors. One of them is positioned in the absolute best tax scenario of her retirement and does not realize it yet. Helen is 68 years old, retired government worker from Florida. She has a traditional IRA balance and a modest pension. She has learned about Roth conversions, but every time she researches them, she encounters warnings about owing taxes and concludes it is not worth the hassle. What Helen does not realize is that at her earnings level, a properly sized conversion this year would cost her very little in extra tax, and it would permanently pull that money away from the grip of future required minimum distributions. Every year she delays, her IRA continues growing. Every year it compounds, the required minimum distributions at 73 become bigger. At her existing balance, those distributions will begin at approximately $6,800 a year and climb from there as the account expands. That money will stack on top of her pension and her Social Security and force her into a bracket she has never experienced. And by the time those mandatory withdrawals begin, Helen will have zero choice. She pulls every dollar out on the IRS timetable, not hers. Thomas and Linda are both 64. They stopped working at 62 from an industrial company in Wisconsin. They are postponing Social Security until 70 to maximize their monthly payment. They have not enrolled in Medicare yet. Their sole income right now is a modest pension and some dividend earnings. Their combined modified adjusted gross income falls under $60,000. This is the premium opportunity inside the premium opportunity. Their tax brackets sit at the very lowest. No Medicare costs are being impacted yet. Virtually none of their earnings are driving Social Security toward taxation. And Linda turned 65 in December, which means the senior bonus deduction becomes accessible to her beginning this tax year. Thomas and Linda should be converting as aggressively as their limits permit right now. Instead, they are holding off. They do not realize that this period between retirement and Social Security, between minimal income and mandatory distributions, is the optimal tax window of their whole retirement. Richard is 71. Retired financial analyst from Arizona. Richard understands Roth conversions. He has been executing them. His error is the reverse of Helen and Thomas and Linda. Richard converted an excessive amount in 2025. He drove his modified adjusted gross income past $212,000 without properly considering Medicare's 2-year look-back provision. The earnings from that conversion are now determining his Medicare Part B and Part D costs for 2027. He took the right step at the incorrect amount, and he cannot reverse it. Here is what Helen and Thomas and Linda and Richard all share in common. None of them were aware of the 3 pitfalls that are embedded in this opportunity. And if you convert without understanding where these boundaries are, you can wind up spending more than if you had taken no action at all. Pitfall number 1, the senior bonus phase out. The new senior bonus deduction starts to diminish once your modified adjusted gross income passes $75,000 for single filers or $150,000 for married couples filing jointly. For every dollar beyond that limit, you forfeit 6 cents of the deduction. That means a Roth conversion that elevates your income past those figures does not simply add taxable earnings. It also starts erasing the very deduction you were relying on to lower the expense of the conversion. Your bracket indicates 22% in the phase-out range. Your true effective rate is steeper. You have to understand precisely where your earnings fall before you transfer a single dollar. Pitfall number 2, the IRMAA cliff. IRMAA represents income-related monthly adjustment amount. It is a Medicare surcharge that kicks in when your modified adjusted gross income from 2 years earlier exceeds specific thresholds. In 2026, the initial cliff is $109,000 for single filers and $218,000 for married couples filing jointly. Exceed that boundary by $1 and your Medicare Part B and Part D costs spike, not gradually, in a cliff. And because Medicare references 2 years back, a conversion you execute today influences what you spend for Medicare in 2028. You cannot undo it after December 31st. Pitfall number 3, the Social Security torpedo. If you are currently receiving Social Security, Roth conversion earnings count toward your provisional income. That is the IRS calculation that determines how much of your Social Security faces taxation. Below $25,000 for single filers and $32,000 for married couples, your Social Security is not taxed whatsoever. Above $34,000 for individuals and $44,000 for joint filers, up to 85% of your benefits can become subject to tax. A conversion that drives you past that boundary does not merely get taxed on its own. It activates taxes on money you were already collecting. The actual expense of that conversion is considerably greater than your bracket number implies. And most retirees never anticipate it coming until they review their tax return. Here is what I want you to grasp about these 3 pitfalls. They are not IRS schemes. They are mechanical provisions that interact with one another in ways that are entirely hidden unless you understand to search for them. The risk is not the provisions. The risk is approaching a Roth conversion as a basic calculation. Checking your bracket, seeing 22% and converting whatever amount fits. That is not how it functions in 2026. Your true effective rate on a conversion depends on what it does to your senior bonus, your Medicare costs 2 years from now, and how much of your Social Security becomes subject to taxation simultaneously. The retirees who execute this correctly convert the proper amount each year for the remaining 3 years of this opportunity, remain below all 3 limits, and transfer their IRA funds into tax-free standing before the senior bonus vanishes. Those retirees can protect tens of thousands of dollars in lifetime taxes. The retirees who take no action forfeit the opportunity entirely. The retirees who convert without recognizing these interactions can wind up worse off than if they had never converted whatsoever. Both directions are expensive. Only one direction is correct. Here is your action plan. 7 steps beginning this week. Step 1, retrieve your most recent tax return, Form 1040 or Form 1040-SR. Locate your modified adjusted gross income on line 11. This is your baseline number. It reveals exactly where you stand relative to all 3 limits before you convert anything. Step 2, research your future required minimum distributions. Visit irs.gov and search publication 590-B. It includes the Uniform Lifetime Table. Locate your age and your existing IRA balance and determine what the IRS will require you to withdraw at 73. That figure is what you are working to decrease right now before it becomes permanent. Step 3, verify you are utilizing the Senior Bonus Deduction. If you are 65 or above, it is $6,000. If both partners are 65 or above, it is $12,000 combined. It is reported on Schedule 1A attached to your Form 1040. Many retirees who already submitted their 2025 return did not report it because they did not realize it existed. If that describes you, consult with a tax professional about submitting an amended return. Step 4, before transferring a single dollar, determine your 3 firm boundaries. Boundary 1, the senior bonus phase-out. which begins at $75,000 for single filers and $150,000 for married couples. Boundary 2, the IRMAA cliff at $109,000 for individuals and $218,000 for married couples. Boundary 3, the Social Security taxation limit at $34,000 for individuals and $44,000 for joint filers. Your conversion this year must remain below whichever boundary you reach first. Step 5, cover your conversion taxes from outside the IRA. This is one of the most damaging mistakes retirees commit. If you convert $100,000 and withhold $22,000 from the IRA itself to handle the tax bill, only $78,000 enters the Roth. That $22,000 compounding inside the Roth over 20 years would have been worth far more than the conversion benefit. Cover the taxes from savings or a taxable account. The entire converted sum should be growing inside the Roth from day one. Step 6, partner with a tax professional who has specifically adapted their methods for the one big, beautiful bill modifications. Not every CPA or financial planner has completed this. Ask them specifically about the Senior Bonus Deduction interaction with IRMAA and Social Security taxation. If they are not knowledgeable about how those three provisions interact in 2026, locate someone who is. Step 7, do not postpone until December. Most retirees who execute Roth conversions complete them at year-end. That is the poorest timing because you have the least information and the least flexibility to correct if something is wrong. The smoothest conversions occur mid-year when you have sufficient actual income data to understand exactly where your modified adjusted gross income sits before you transfer a dollar. Susan is 73 now. She is accepting the required minimum distributions she cannot dodge. She is covering the taxes she cannot avoid. She is watching a 4-year opportunity that she never learned about disappear behind her permanently. You are not Susan yet. The opportunity is still available. You have 2026, 2027, 2028, 3 tax years left. After that, the senior bonus deduction vanishes. The additional space it provided vanishes with it. The expense of converting rises back up. And the IRS will still be waiting at 73 mailing notices, demanding distributions, collecting taxes on every dollar you left, parked in that traditional IRA. If this video helped you comprehend something your financial planner has not addressed, press the like button right now, subscribe, and activate the bell so you never miss a video. And forward this to someone who holds a traditional IRA and does not realize this opportunity exists. They need to watch this before 2028. Share in the comments, are you currently executing Roth conversions or have you been holding off? Every single one gets read and the most frequent situations turn into future videos.